Why NGC changed its credit rating strategy, an editorial by Dr. Valmiki Arjun, UWI lecturer in finance, president of the Trinidad and Tobago India Business Federation. When a company parts ways with a credit rating agency, the instinct is to assume it is hiding something and not being transparent. In NGC's case, that instinct is likely wrong. A credit rating is an independent opinion on a borrower's ability and willingness to repay debt on time. For NGC, it carries considerable importance. The company sits at the center of TNT's gas value chain, responsible for transmission, distribution, LNG linkages, supply to petrochemical companies, and government revenue flows. How the international capital markets assess NGC's creditworthiness affects its borrowing costs, access to long-term financing, the confidence of counterparties, and even the broader perception of TNT's energy sector credibility. It also signals to the market that NGC's debt, liquidity, cash flow, and governance are being measured against global standards. NGC has maintained credit ratings since 2005, assessed at various points by Moody's, S&P, and CRIS. This was never optional. The company's own debt covenants require it to maintain at least one international credit rating, meaning the rating process is embedded in how NGC finances itself. In February 2026, NGC ended its relationship with Moody's following a comprehensive review of its rating framework, financial profile, and long-term strategic objectives. Moody's withdrew NGC's BA2 corporate family rating, a sub-investment grade assessment, stating it had inadequate information to continue monitoring the ratings after NGC ceased participating in the process. NGC's position was that Moody's rating did not adequately reflect its standalone credit strength, as its earnings profile, liquidity, and debt service capacity were more consistent with investment grade, while Moody's methodology placed excessive rigidity on NGC's relationship with the GORTT. To understand why this matters, it helps to understand how the major rating agencies treat government-owned companies. Moody's assesses a company's own baseline credit strength, then applies a government-related entity framework, adjusting the final rating based on the probability of government support and the degree of dependence between the company and the sovereign. In practice, this can work against NGC. If Moody's views the company as too closely tied to TNT's sovereign risk because it is wholly state-owned, strategically central, and subject to government dividend extraction or policy mandates, even strong company-level performance may not be enough to prevent NGC's rating from being constrained by the state's weaker fiscal and credit profile. S&P and Fitch generally provide more flexibility in recognizing a company's standalone financial strength, even where sovereign linkage exists. While they still consider government-related risk, their frameworks allow a company's own cash flows, leverage, liquidity, and operational profile to play a more important role in the rating outcome. S&P affirmed NGC at BBB- in September 2025, while keeping the standalone credit profile at BBB-. That is important because it suggests that S&P views NGC's own credit fundamentals as consistent with investment grade, even as the rating remains aligned with the sovereign ceiling. If an agency's methodology gives more meaningful recognition to NGC's standalone profile, including its market position, strategic infrastructure, gas transmission role, balance sheet, cash generation, and quasi-monopolistic position in the gas value chain, the rating outcome can be stronger than under a methodology that more heavily compresses the company towards sovereign-related risks. Fitch's framework similarly weighs standalone credit characteristics and explicitly allows a government-related entity to be rated above the sovereign in certain cases where the standalone profile is stronger and the government has limited access to the entity's cash or assets. It is reasonable to say Fitch's methodology could allow NGC's standalone financial strength to play a meaningful role, though an investment-grade outcome cannot be guaranteed without seeing Fitch's final assessment. The case for NGC's standalone strength is not simply an assertion. There is evidence that NGC's financial performance does not move in lockstep with the broader economy. In 2016, Trinidad and Tobago's economy contracted by over 7%. Yet NGC Group's after-tax profits increased by 28% to $721 million that same year. Its revenues are substantially tied to international gas and petrochemical markets rather than domestic economic conditions alone. A methodology that treats NGC as inseparable from the sovereign may therefore be structurally ill-suited to capturing how the company actually performs. NGC has also stated that its 2025 financial performance reflects the strongest profitability in 11 years, with forecast revenue of approximately $23.7 billion and profit after tax of approximately $3.3 billion. Maintaining investment-grade status is not a symbolic goal. Many institutional investors, pension funds, insurers, and international lenders operate under mandates that prohibit them from investing in speculative-grade debt/bonds. Even a single-notch difference between investment-grade and sub-investment grade can significantly affect interest rates, refinancing flexibility, collateral requirements, and market confidence. For a company that may need to finance major infrastructure investments, pipeline expansions, or strategic energy developments, preserving investment-grade access is economically important. It also influences international investor confidence in TNT's broader energy sector. This brings us to another commercially decisive reason for NGC's decision. In the capital markets, many investors pay attention to the lower of a company's two ratings. If Moody's rated NGC below investment grade while S&P held a more favorable view, the Moody's sub-investment grade signal might have actively offset the benefit of the higher rating, raising NGC's effective cost of capital regardless of what S&P concluded. Management arguably has a fiduciary responsibility to pursue the most accurate and economically efficient representation of the company's creditworthiness. If Moody's methodology was structurally constraining NGC's rating below where its true credit quality lies, seeking alignment with agencies whose frameworks better recognize standalone strength is prudent capital market strategy, not ratings avoidance. Critically, NGC did not abandon the international ratings process. It is maintaining international credit coverage through S&P and exploring a possible new ratings relationship with Fitch. In contrast, a company that withdrew from all external ratings would rightly face serious questions about transparency. Selectively choosing agencies whose methodologies better capture intrinsic credit strength is not unusual in global corporate finance, and no company is obligated to remain with an agency it believes structurally misrepresents its credit profile. Should Fitch ultimately assign NGC an investment-grade rating alongside S&P's existing BBB-, it could reinforce the argument that Moody's methodology was comparatively harsh in its treatment of sovereign linkage and would validate the strategic rationale behind the decision. As NGC maintains rigorous disclosure, publishes audited financials on schedule, and engages its counterparties transparently, this is not a retreat from accountability. It is good corporate strategy.